building wealth, like a long-term relationship. The best piece of advice I've ever heard about investing came from a millionaire I looked up to as a kid. One day, I overheard him talking about stocks, and I couldn't resist asking him, how do I pick the right stocks to invest in? His answer? Treat it like finding a girlfriend. At first, I thought he was joking, but it's actually a clever way to think about it. When you buy shares in a company, you're essentially entering a partnership, just like a relationship. And like any good relationship, you want it to be happy, long-lasting, and successful. But hey, let's be real. There's no crystal ball that can predict the next skyrocketing stock. That's the fantasy peddled by fake gurus. What I'm here to do is show you the fundamentals, the real strategies to improve your odds in the market. When you're looking for a partner, you don't just wing it, right? You think about your approach. Maybe you're the type to shower them with gifts, or perhaps you're a treat them mean, keep them keen kind of person. The same principle applies to investing. You need to figure out your strategy, and in the stock market, there are two main approaches: technical analysis and fundamental analysis. Technical analysis is like speed dating. It's short-term and based on quick patterns, using charts to predict if a stock's price will go up or down. But let me warn you, this approach is high risk. In fact, over 95% of day traders lose money. Fundamental analysis, on the other hand, is like getting to know someone deeply before committing. You dive into the company's financials, leadership, and growth potential. It's a long-term approach that can help you build wealth steadily over years, not days. Let me show you how this works with an example. Let's check out Coca-Cola's financials. I'm using Trading 212, which makes it easy to explore balance sheets, income statements, and cash flow reports. The first thing we'll look at is the balance sheet, a snapshot of the company's financial health. Think of it as a cookie jar. At the top, you've got the cookies you can grab right now, current assets. Deeper down are the long-term assets like the company's factories and patents. And of course, liabilities are like cookies you owe to your friends. Now here's the important part. Divide the company's total current assets by its total current liabilities. For Coca-Cola, this ratio is 1.13, meaning they have $1.13 in assets for every $1 in debt. A good sign they can handle short-term obligations. But numbers aren't the only thing that matters. Just like you'd ask about someone's past relationships, you need to check a company's track record through its income statement. It tells you how much money the company made, how much it spent, and whether it's growing. And don't forget the cash flow statement. This reveals if the company can manage its money well. Are they reinvesting for the future? Are they drowning in debt? These are red flags you can't ignore. Finally, let's talk about qualitative analysis. This is where you step beyond the numbers. Look at the company's brand recognition, leadership, and competitive advantages. For instance, companies like Apple thrive because of their strong customer loyalty and market dominance. Look, investing is like any relationship. It takes time, effort, and patience. If you're here for quick wins, this isn't the video for you. But if you're ready to build wealth for the long term, you're in the right place. Comment "I'm in" below if you're ready to commit to your financial future, and don't forget to like, subscribe, and hit the bell so you don't miss any of my upcoming videos. And if you want to dive deeper into how I use index funds to build wealth passively, check out my next video here. I'll see you over there!